Hi there. If your spending does not match your reported income, this guide explains how HMRC may investigate and what records you need to keep.
In recent years, HM Revenue and Customs has transitioned its enforcement model from reactive, manual checks to a system defined by real-time data surveillance. They now prioritize automated data matching over retrospective paper audits. This means that if a taxpayer declares a modest salary of £20,000 on their self-assessment, but regularly purchases luxury watches, pays for international flights, and finances high-end vehicles, the system flags the mathematical discrepancy. HMRC's internal AI, known as Connect, currently processes over 55 billion individual data points. By cross-referencing your declared income against your actual spending, this system recovered an additional £4.6 billion in unpaid tax in a single year. I am your host from My Tax Accountant, and today we are going to run a personal Connect audit. We will walk through the exact steps HMRC uses to evaluate your finances so you can identify your own risk factors before the algorithm does. Because every expenditure leaves a digital or physical footprint, hiding cash income now requires bypassing a network of 55 billion data points. In this landscape, your observable lifestyle acts as your real tax return, and understanding how HMRC analyzes it is necessary to protect your wealth. Step 1 is the consumption income divergence test. HMRC's algorithms are no longer looking for hidden invoices or missing receipts. Instead, they look directly at the money you consume. This split-screen visualization shows exactly how HMRC maps that data. Take a freelancer who declares an £18,000 profit. If their banking and public records show they spend £28,800 annually on rent, car finance, and basic living costs, the system triggers a flag for immediate review. To verify these numbers, investigators now utilize Financial Institution Notices, or FINs. These notices allow HMRC to bypass independent tax tribunals and taxpayer consent entirely, pulling your personal bank statements directly from your financial institution. Even cash leaves a permanent digital record. When you use undeclared physical cash to upgrade a home, register a vehicle, or pay municipal bills, those actions are logged into government databases that Connect monitors 24/7. Spending undeclared cash creates an undeniable digital receipt for HMRC investigators. Every luxury purchase or property upgrade is traceable. Step 2 is the digital footprint audit. Open a browser and search your own name to see what open-source intelligence HMRC can easily scrape. Beyond basic web searches, Connect receives automatic real-time data feeds from digital side hustle platforms like Airbnb and Etsy, as well as international cryptocurrency platforms under the Crypto Asset Reporting Framework. HMRC also monitors public social media accounts. Posting luxury travel, expensive watches, or high-end dining builds a visible lifestyle profile. If that profile outpaces your declared tax band, the algorithm assigns you a high-risk score. Step 3 is an essential preventative measure. Hard separate your finances. This is mandatory for small business owners and company directors. 2 specific banking habits instantly attract the AI's attention: maintaining a persistently overdrawn director's loan account and commingling your business revenue with your personal grocery and utility spending. By keeping your business and personal accounts strictly separated, you starve the algorithm of messy data, lowering the risk of triggering a manual compliance check. Step 4 is preparing for making tax digital. The traditional annual paper tax return has been completely replaced by digital submission rules. This timeline chart highlights the new reporting rules. For property owners and businesses earning over £50,000, the law now mandates the use of approved software to submit detailed quarterly digital updates starting in April 2026. The financial consequences for ignoring these updates are significant. To enforce the new digital standard, HMRC is doubling late filing penalties. Step 5 is taking action. If you identified any mathematical discrepancies or digital inconsistencies during this audit, you must execute a preemptive disclosure. Waiting for HMRC to send a mandatory self-correction notice locks you into the highest fine brackets. Conversely, making an unprompted voluntary disclosure, such as using the Let Property campaign, guarantees legal protection and immediately reduces your financial penalties by 15 to 30%. Under a system of real-time surveillance, confessing anomalies before the algorithm forces you to is the only way to minimize fines and avoid criminal prosecution. Congratulations on completing your personal Connect audit. By understanding these metrics, you have taken the first step toward aligning your financial records with your observable lifestyle. 55 billion data points do not lie. With every bank transfer, property deed, and social media post mapped and cross-referenced, tax evasion has become an unwinnable data problem for the modern taxpayer. Please note that the information in this video is for educational purposes only. It does not constitute formal tax or legal advice, and you should always consult a qualified professional regarding your specific situation. If your personal audit revealed any red flags, do not face HMRC alone. The team at My Tax Accountant has the experience required to handle unprompted disclosures safely and legally. Contact us today at 020-857-08531 or email info@mytaxaccountant.co.uk to secure your position. And if you found this guide valuable, please like the video and subscribe to the channel for more updates. In an environment where HMRC sees everything, proactive compliance with a qualified professional is the most effective way to address anomalies before they trigger an investigation.